What's up, outliers? We have, I think, our final options trading for beginners session for today. So I am slightly, I don't know. We'll still do the live sessions on Friday, but I'm going to pivot away from like the specific focus necessarily on like a topic. It'll still be for beginners, but I'm going to leave it to be a little bit more open-ended. So the goal of the session for today is actually to walk through a path forward and to talk about 3 of the biggest mistakes that I see. And hopefully the goal here would give you some ideas on how this trading journey will look like for you going forward. So I am very excited to get into this. I'm also very excited because I have a new self-inflating lumbar support thing so that I could hopefully sit a little more comfortably. Looking forward to that. But as you know, we got to say hello to everybody. Let me grab this chat and let's get right in. So a few things right from the jump. As always, this is a live session. So feel free to jump in with anything that you want to cover. That is the entire goal. I'm going to get through some set material first, and then we'll go more into like the open-ended side of things. But yeah, come with whatever you want to talk about. All right, so the starting point for the session today is 3 common beginner mistakes. And there's essentially an entire listicle series you can do off of this. You could do 10, 15, 20, 50, like there's a bunch of trader mistakes. But the goal for this is to talk about it in kind of a broad sense. And the reason why I want to talk about it in a broad sense is because I think that by covering these broader topics, I think you will have some tools to then build out going forward that cover specifics. So as most of the stuff that I do, you're not going to get a lot of highly prescriptive things like never do blank. Because guess what? Like I've learned in my trading career that sometimes there is a time and reason to do whatever it is that you're never supposed to do. So I don't really speak in absolutes. So let's talk about where this begins. And it starts on this blank screen. But the first thing I actually want to start with before I bring up the first item that I think is a really common mistake is I want to ask you in the chat. So if you were to summarize the top 3 biggest trading mistakes, focused a little bit on options traders, obviously, what would you guess they are? And you can throw 1, 2, or 3. I want to give you a few seconds to think about that. And while you're answering, my guess is we are going to see a highly varied set of answers. And I want to highlight that, the fact that I'm expecting a highly varied set of answers. Because if I don't see a highly varied set of answers, obviously I'd be completely wrong. But my guess is that your answers are actually going to introduce my first point, which I'm excited for. So Reese says for myself or all traders, whatever, it's up to you. Joey says probability of profit versus expectancy. That's a really interesting one. Roaring Titty is focusing on changing stops and not thinking about entries and exits. I like that. Brad says expiring too soon, things that are out of the money. I think that's a good one. Elong Song says not knowing how to roll covered calls. Another really good one. So I would qualify these as kind of tactical levels. So for those that are unfamiliar with like the military hierarchy, crap, I just dropped my thing. 1 sec, I gotta grab that. Literally just I just scared the crap out of Thor because I dropped my little tablet when I was trying to grab it. And Thor was just like, yo, I'm not here for that. He's literally sitting at like alert right now. All right. We had to make sure that the homie was good. So for those that don't know, the military kind of thinks about different layers and levels very specifically with respect to how we organize stuff. So when we talk about trading, a lot of what I do is adaptations of what I've learned in the military. So one of the things here is we have strategic level. Then we have operational. And then we have tactical. So I'm not here to teach you about military history and orders process and stuff like that. This is all going to be trading focused. I just want these relationships to make sense to you as I use them, because it's literally how I talk about this stuff. So just think strategic is like the 30K, even bigger than that probably. Call it like the 100,000 foot view. And then maybe call this like the 30K foot view. And then we would call this kind of like front line. So essentially, a lot of the things that you highlighted to me, so things like probability of profit versus expectancy, I would bucket that here. Something like changing stops, bad entries, exits, I would bucket that here. Something like buying options that expire too soon, like Brad's talking about, I would bucket that here. Something like not knowing how to roll covered calls, very specific, that's very tactical. Taking profits early, which is kind of a dovetail off of Joey, I would probably bucket that here. That Lauren says forgetting to look at theta, I would bucket that here. Ricky says taking profits early doesn't seem like a big issue, better than watching your trade go red. We now have a really important conversation to have, because anybody that knows me is probably, I am going to disagree vehemently with Ricky, vehemently. And their position is not unfounded. I understand that mindset. And it's because that's one of the perversions of the trader mindset, is you're taught that that's supposed to be enlightened, right? The idea of take a smaller profit rather than let your trade run red, right? That sounds not greedy. It sounds like you're doing the right things, but it's actually not enlightened at all, unfortunately. So, Ricky, it's a completely reasonable thing to say. I would have said the same thing. Like, there's absolutely nothing wrong with that as a theory. The problem is it's a perverted theory that people don't fully understand. So we'll talk about that in a little bit, but earmark it, because what you brought up is completely fair and it's so common. And I want to make sure we talk about that specifically, but absolutely fantastic point. Vladimir says, I closed some calls. Reese says, Eric might disagree. One of the biggest things I've learned from him. Yeah, exactly. Reese is spot on. I do disagree. Cedric says, looking at macroeconomic events. That's interesting, because I actually don't think that's bad. I think overweighting it wouldn't be good, but I would call macroeconomic events probably somewhere like here. I would call it maybe operational, maybe a little bit of strategic, but mostly operational level still. Roaring Titty, everybody, shout out to Roaring Titty, one of the greatest names on earth, says, triggered. Cedric says, I am of the belief most money is lost, not in a recession, but preventing one. It's the same with profit taking on trading. That confuses me a little bit. I think we'll talk about it a little bit, but the idea about profit taking is not, most people I notice, especially when I'll take a position on something, they'll generally think that if I disagree with a position, that then I inherently mean the inverse, which is actually very rarely the case. But I think something like profit taking, the way I would bucket it broadly, is that it's very, very nuanced, which we'll talk about. And Mike says, hey, fellas, Mike, it's fellas and ladies to you. I will happily let you know. Hold on. Let me check my YouTube analytics right now. I am overflowing with female audience members. It's like, it's incredible how many. What's your guess? If you were to speculate how many male versus female as a percentage, what's the percentage you would guess? Here, I'm going to start a poll. What percentage of Eric's audience is male? Less than 10%, less than, we'll do 25% to make it faster. Less than 25 to 50%. Then we'll do like 50 to 75%. Okay, so all right, well, I realized that the poll is, you guys are all way closer than I was expecting. I thought I might have misled you well enough, so I actually need to reconfigure my poll because apparently I didn't trick anybody. So we'll do like 80. I think there's actually enough responses in here I can probably just guess. So I see 80%, 99%, 93%. I see Lauren raising her hand, offering herself as the notification that there is a female. Roaring Titty is letting us know that there is a second female with us. So yeah, fun fact, it is 94.4% male, 5.7% female. And then it looks like the bulk for Brad says under 35. Fascinating enough, it's not. So under 35 is 27.4% at 25 to 34, and then 4% 18 to 24. So the bulk of my people, this is actually news to me, the bulk of my people are 35 to 44, 34%, with 20% 45 to 54, and then 10% 55 to 64, and then 4% 65 plus. Fascinating. That was actually kind of fun. I wouldn't have guessed some of that myself. Vladimir says, wait, how do you know the gender, Eric? It's a great question, because what even is I'm in California, so I don't even know what a fucking gender is at this point. So yeah, I mean, one of my favorite things to do, I'm not even kidding, is when I go places like physical therapy and whatnot, and like you're filling out the forms, I literally will fuck around and I'll say that, oh, I'm obviously a female. Like, it's kind of shocking to me that you could think I'm anything else, but, and that's obviously for the people that, you know, are trans or whatever it is, like whatever makes you happy makes me happy. But I also like to play games and fuck around with people because it's fun. And I think it's completely fair that most people would assume I'm male. It's a fair guess, but it's very fun in California to, like, every time I go donate blood. My favorite thing is if I have the ability to fill out a form before I go. And then I get to, because then obviously they're expecting something. And then normally I'll do, you know, that I'm a 6 foot, 223 pound female. And I just find that very entertaining. It's very confusing to people, which I'm here for. So, Brad says, what percentage of your audience is non-binary? Actually, it showed 0% as like non-disclosed, I think it calls it, not necessarily non-binary. But Joey says Eric is going to get estrogen by accident one day. That would be hilarious. Because actually, if you get some estrogen, it can actually spike testosterone, because testosterone starts to counteract the excess estrogen. So maybe that's the way to do it. Roaring Titty says Native Americans recognize several genders as well. Yeah, definitely. Well, I think the problem is, well, I don't want to get into that debate, but yeah, I think I like telling people when I'm going to an appointment that I'm female because I find it funny. But beyond that, Lauren says, I'm so old that when they asked me in a medical forms what pronoun I was, I didn't know what it meant. Same. That one's also very funny to me. But I just come from like, just treat everybody with respect. As long as there's mutual respect, I don't give a fuck. That's how I feel. So back to trading though, a lot of the things that you all highlighted, in my opinion, fall in this bucket. The very, very tactical level bucket. And that's okay. This actually is in line with what I would expect a newer trader to think they should be focusing on, is the very tactical level of things. Now, if you know anything about me or the content that I produce, you're probably going to be a little upset for this video about 3 common beginner mistakes, because we're actually going to spend all of the time up here. And here's why. If you get the strategic and operational components of trading down, literally, the tactical level of trading will straight up take care of itself. It will take care of itself. And I know that sounds weird, esoteric, but it's really not. It really is not, and you'll see why. So the goal here is to try and offer a way to model and think about trading that's sustainable and does well. Cedric says strategic guess, valuing a company, even higher level than that. So in a trading way, well, it kind of like in a trading language, the way that I think about the strategic level, that was a fun squiggly line. The way I think about the strategic level is like, we're literally talking about things like philosophy. We're talking about self-awareness. We're talking about habits and dependencies. So at this strategic level, we're talking about literally what governs everything else we do. At the operational level is how we trade. What's our approach? What do we think we do? That's operational level. What's the broad mandates that we follow? Tactical level is the execution of the skill set. So let's now take a look at what Eric seems to believe these 3 mistakes are. We'll start with the very first one, lack of structure. Does this surprise you in the least that I would call this out? Like, to me, as I think about the very first mistake every single option trader makes, myself included, is a complete and utter lack of structure. 100%. So for example, I have another question for the chat. If you were to tell somebody, these are the first 3 things you need to learn in order to be an options trader, what are those things? What would you tell them? And I'll give you a few moments to throw it in the chat. You can list 1, 2, or 3, whatever you want. But I want to know from each person that's willing to participate, what are the 3 things you would tell somebody that says, hey, I want to be an options trader? What are the first 3 things I should do? What are those? And again, what I'm going to highlight is something that I don't think most people consider. So far, Cedric says, understand the mechanics of options and why they are used. Completely fair. I think that that's very reasonable. Joe says risk management, also completely reasonable. Elong Song says block some time to learn. Got to create a space in order to pick up the skill set. Makes a ton of sense. Off Putin says paper trade first. I also think that that's a fair answer. Roaring Titty says position size, stops, something delta. Fair. I don't think anything, those are like good foundational concepts. Paulo says learn technical analysis. You got to figure out what you want to trade. That Lauren says learn the Greeks. We need to know how options behave. I'd rather be skiing. Says risk/money management. So we've seen that one, the very first one, twice now. That's the only thing we've seen twice so far. Create a planned system, create rules to follow that plan and never deviate. Let's talk about that one just a little bit in a second. Joey says purpose and portfolio fit. got to know what we're trying to do with our money. So Brad says, learn to control your emotions. Huge one. We're actually going to talk about that one. So let's go to I'd rather be skiing's comment. Specifically, the create rules to follow that plan and never deviate. So if I were, let's say a jiu-jitsu player, and let's say that I'm a white belt. And I actually technically am a white belt because I've been a jiu-jitsu dude my whole life, essentially for like 15 years, but I've been in a gi like 4 times. So technically I am a white belt. I actually love being able to tell that people with a clear conscience. So, if I'm working with a brand new white belt, is it fair for me to say to a white belt, create your own approach to jiu-jitsu and never deviate from it? Make your own and never deviate from it. Do we think that that's reasonable for me to tell a brand new jiu-jitsu player? No, doesn't make sense, does it? But we say it all the time in trading. We say it all the time in trading. We tell new traders, make a plan and never deviate because it sounds good. It makes sense. But guess what? They're the last person that's in a place to make something that they should never deviate from. They don't even know what they don't know yet. And again, I'd rather be skiing. There's absolutely nothing wrong with what you said because it makes sense. That's another thing that you absolutely consider as a new trader because you'll hear that. But again, it's just not logical. OMG Legend says 15-year white belt. I think if you're grappling in BJJ for 15 years, you're grappling and not ranked via a belt. I mean, technically speaking, they still will, like, we still do belts for no gi, but it's like non-traditional. That's why I make the joke. It's like in a traditional sense, I literally have been in a kimono like literally less than a handful of times. So in a traditional sense, I am absolutely a white belt. But yeah, I mean, I've been grappling the vast majority of my adult life. It's actually super fun too. Like I said, it's always hilarious to me. Like if I'm traveling somewhere and I go to a new gym and they're like, what level are you? Again, I can say with a clean soul, like I am a white belt, but that's not my skill level, I don't think, but it's my technical level. So pretty fun. So anyways, in this context, back to trading, as you guys could tell, right? Like the same thing when I'm doing the doctor stuff. I just like fucking with people. I just like these little jokes, specifically that denigrate me more often than not. But I like jokes. I think it's funny. Yeah, exactly. Joey picked up on it exactly. I just like playing with people. It's fun. Another one of my favorite things to do is whenever I donate blood and they say like, oh, are you scared of needles or anything? I always tell them that I'm fucking terrified. And every time it's like magic. They end up pairing me with like this really tiny nurse that's always super sweet and nice to me. And then every time I stand up after donate, I pretend to pass out to see what they would do. Fun fact, all of them would let me drop on my fucking face. But I love doing that too. It's too funny. It's way, way too funny. So yeah, I enjoy having some fun with people. It's a good time. So if we think about though, exactly what we're talking about with like a new trader creating their own rule set. Very difficult to do that. So then how do we get there? Let's say, oh, I haven't thought of that one. Joey, that one's actually hilarious. Joey says, whenever I go out to eat, I order something. And then when they ask if I have allergies, I say one of the main ingredients. I literally love that. It's like getting a pizza and be like, oh yeah, I'm allergic to flour. Can't do flour. I love that. That's so fun. All right. So lack of structure. Where does this all go with lack of structure? It's super simple. The idea is if I were to tell somebody, you need to teach a 10-year-old, let's just say the 10-year-old is a non-native English speaker, and you need to teach a 10-year-old how to speak English, what's the very first thing you would have them learn? The very first thing. Throw that in the chat. My guess is we'll probably find a little bit more of a trend here. That's my hypothesis. Run, spot, run. I'm assuming that's a reference to something, but I actually don't know what that's from. Alphabet is what Brad says. Villalobos says picture books. Paulo says common words. I'd rather be skiing says maybe saying their name in another person's name. Okay, so Joey goes with I, you, they, them, us, we. Okay. I'm not even gonna lie, this is more varied than I thought. But it still highlights an interesting point because I can see some very common threads as I look at this. So Brad is starting with the alphabet. What are the letters? What are the symbols we use to represent noise? And then other folks like Villalobos, Paulo, Vladimir, I'd rather be skiing. They're going with more the practical approach, right? So those are like two giant differences between the methodology that we literally just summarized if somebody was to start to learn English. We have the structural approach, alphabet. And then Joey used like specific words or phrases. And then there's kind of a more experiential approach. This is more go watch a movie with subtitles. This is talk with kids as you're, out playing with them or whatever. If we look at this, there's two kind of general approaches here, but what's common behind all of this? The main commonality I see is we're starting with basics. However we get to those basics, but we start with basics. Okay. So now why am I going through this example with you is because I'm trying to highlight a completely different model that we apply in trading. So one more example, and then I promise I'll tie it in. If I were trying to teach somebody math, right? Let's say that they're new to math. What are some of the beginning ways that I would teach them math? I would probably start with things like derivatives, or maybe I'll start with like proofs. No, obviously not. I would start with numbers. I would start with addition, subtraction. Maybe hit them over the head with some PEMDAS. Maybe then move them to algebra. Samoda says taxes. That's the last thing I would teach somebody that's new to math because I wouldn't want them to quit on life before they even started. I feel like that would just be absolutely brutal. Absolutely brutal. So when we look at the learning process, though, for something like math, what I'm highlighting is regardless of your background with math, there's a general approach you would take. You would start with some basic shit. You would then start with some less basic shit. Then you would go to some moderate shit. Then some like medium moderate shit. And this happens like year over year over year. This happens with a teacher showing you how to do it. This happens with exams. This happens with quizzes. This happens with projects. Yes, I actually had fucking math projects. You want to talk about a demoralizing event? Do a math project. So when we look at the process of learning math, or really anything else, it's a very building block approach because exactly to Brad's point, still got to learn numbers. He's 100% correct. It's the same thing when we're talking about learning English. If you're going to learn English to be able to like speak, read, and write, you still have to know the fucking alphabet. So there's basic things that you learn. Yet, if I go back up to what you guys told me, you would tell a brand new options trader they should start with, I saw things like risk management, which is good. There's nothing wrong with that, but that's pretty specific. I saw something about probability of profit versus expectancy. I would see a common mistake of not knowing how to roll covered calls. So if we're talking about first steps, there was stuff like learn technical analysis. Shit. What is technical analysis? If I'm a new options trader, what the fuck does that even mean? So what I'm highlighting and hopefully delivering together with a bow is that the first step for a new options trader is to build a fucking structure to learn, because you are in the Wild West. There's nobody out there telling you what to do. There's nobody out there that's quizzing you on what you've learned. There's nobody out there giving you practice fucking problems. It is you, the individual. It is all you. So the whole point here, and this is again why I built this exact thing for us, and this isn't even what I would consider to be like the ultimate end state. This is just something to offer somebody so that you have something, because I recognize that there's a giant gap for this, that people want to start talking about things like probability of profit versus expectancy, which is a really important lesson. But should that happen before compounding interest is well understood? And my guess is, just like if we all took, myself included, if we all took a basic math test that like a 5-year-old had to take, we probably would not get all of those questions right, I would guess, because you know how that goes. Sometimes those kind of math problems can be like really, really specific. The point is even people that are really well-seasoned traders, my guess is if you go through these starting modules like this, you'll probably find a bunch of shit that you don't know. Probably. So even though we're trying to operate down here on using intraday GEX in 0DTE SPX options to inform entry periods, we might not know some of the fundamental concepts that govern literally the process of trading or learning. Notice how the humor of all of this is, and I will continue to reiterate this point because I think it's very important, is that the question I say is most common option trader mistakes. I haven't even mentioned the fucking word options yet. I haven't even said the word because it doesn't matter. Options themselves are just vehicles. We have to get a lot of other things solidified first before we even think about options, which leads us to the next common mistake. It's a broken foundation to options or trading in general, because most options traders immediately start jumping in somewhere like here. This is where we have an options trader that's relatively new. Maybe they've studied options for a few months or a few years. And they're like, well, this is going to be my strategy because I'm supposed to make a plan that I never deviate from. So my plan is going to be to buy 7-day options that are at a 15 delta because they're really cheap and it controls my risk, right? That's what I'm supposed to do. That's another thing that we covered that is super important is risk management. So if I buy these call options, then I'm controlling my risk from the jump. And then I'm going to exit the trade every single time it's up $2. Because the other thing I was taught is that I'm supposed to manage my winning trades because I can't let a winning trade turn into a losing trade. That's another thing that I'm not supposed to do. So I'm doing a good job now, right? I'm creating a plan that I'm never going to deviate from. I'm managing risk. I'm not letting winning trades turn into losing trades. Guess what? That trader's going to fucking fail. Straight up. That trader that's following all of the rules and doing the right things is straight up going to fail. And it's because they are focusing on the entire wrong shit. They're focusing on the entire wrong stuff. It doesn't even matter yet. And that's why I try to highlight, I'm calling it the big 4 trade process. Because in my opinion, these are the big 4 steps that have to happen if you want to be a successful trader. Every single trade, these 4 steps have to happen. So before I determine if I want to sell a 30 DTE option, 10 DTE option, 5 delta, or if I want to buy the 15 delta, none of that matters if I don't have a completely clear line of sight on what the profit mechanism is. What is it that I'm making money from? The second step is to create a signal. We need to measure the profit mechanism as it sits. We need to know when the profit mechanism exists, and we need to understand the qualities of the profit mechanism. So that leads us to our next spot. And what do you notice so far? This is, again, a video about option trader mistakes. What do you notice? I still haven't even said the word options. I got through the first mistake with not using the word options. It's in there because you do need to learn about options once you develop structure, but the mistake of lacking structure has nothing to do with options. The next thing, broke trade foundation. The first things as part of the big 4 trade process is not about options at all. Literally at all. You don't get to even worry about options until you get here. That's all there is to it. Because here's why. If I'm worried about if I'm going to buy a 30 delta call or buy a 20 delta call, that's what I care about. What happens if the underlying goes down? If I buy a 30 delta call or if I buy the 10 delta call, 15 delta call, what happens? Underlying goes down. Any guesses? Lose money. That's exactly correct. Reese is 100% correct. You fucking lose money. And Joey adds a little color around it, which is important, right? You lose money depending on what it is. So the way and the quality that you lose money, the circumstances will be slightly different. But guess what? You fucking lose money. Same thing to the inverse. Let's say that I'm deciding if I should sell a put or buy a call. Sell a put or buy a call. Underlying goes up. What happens to my trade? If I sell a put or buy a call and the underlying goes up, what happens? Any guesses? Make money, defined with put. Cedric says depending on IV, not so much. Joey says depends, not so much. Doesn't. Brad says say it again. I'll say it again for the homies in the back. If I sell a put or buy a call and the underlying price goes up, what happens? Roaring Clitty says P&L moons, potentially, on the right path. Roaring Titty says income is capped on selling the put. That's correct. Joey says, well, if the call goes up, if it goes up a little, the call may lose money. Not in that scenario because we haven't added anything about volatility. So even we haven't talked about the passage of time, literally just saying if I buy a call, underlying goes up. I'm not adding any other qualifiers. I'm not saying time has passed. I'm not saying volatility has changed. Simply underlying has gone up. Cedric says make money then. It's exactly correct. The point I'm making here is that if I sell a put or buy a call and the underlying goes up, I fucking make money. I make money. So what I'm trying to highlight to you is that this is trading. This is trading. I'm going to keep this is trading. this here. This is what trading is. Because once you understand this, then you can figure out how to best fit what you're doing for your circumstance. But it doesn't matter what you end up choosing if it's built on a faulty foundation. That doesn't matter. You have to understand profit mechanisms first, signals second. That is unequivocally the case. Because then, if I'm a new options trader, but I'm really good at understanding profit mechanisms, I've put in the time to understand things like post-earnings announcement drift. I understand variance risk premiums. I understand the market exhibits positive drift. I understand that if something crosses below a 50-day moving average, on average for this specific product, it'll fall to a maximum of X% before, after a certain amount of days, it rallies back up above it. That's all simple research to do. And once that's done, then I can either sell the put or buy a call. It doesn't matter. I'm going to make money either way. So then I can say, okay, I can fairly reliably identify this profit mechanism as it sits. I understand when it happens because I've tested different signals. I understand the behavior of the profit mechanism. Then I can figure out what structures generally fit with the profit mechanism. Again, something goes up, short put, long call, either or, totally fine. And then I can build strategies about those structures that let me maximize things. So for example, if I'm trading something like, let's look at JPM. If I look at something like JPM, and I see it rallying up here. Let's just say I'm bullish for whatever reason. I don't have anything in JPM, just using it as a random example. So I see a few things, right? Higher lows, higher highs, bit of a decline, but still a higher low that's now rallying up and out. Let's just say I'm bullish for whatever reason. If I'm bullish in here, the next part of what I need to do is say how bullish and in what time frame. Do I think that this is going to skyrocket from 211 to 225? Maybe. Maybe I do, maybe I don't. It depends on the individual trader. But what I'm going to tell you is that if I think it's going to go from 211 to 225 in the next week, I'm going to put on a different trade than if I think it might take a month to get from 211 to 225. Or maybe I think it might catch up to this high in here and then stall out. That's still up. I can still make money on it going up. But instead of buying a ratio call diagonal, maybe I sell puts. Maybe that complements the portfolio better. But the point is, we have to clearly identify what it is we're trying to trade, and then we have to study it so that we understand how it behaves. Another great example is if I'm running any sort of breakout trade. So here I'm going to look for things that have consolidated for at least 10 days and they've stayed within a 15% range. And then I want to see something that's at least 5% greater than a bar ago. Let's see what we get. This is still, my bad. I have to fix this because I want it to be weekly. So it's a smaller population that it's scanning. There's only 12 there anyways. Nike. I don't actually love that. Let me clear that. Let's see what these 12 were. Here. This is a good example. I don't know this from a hole in the wall. I'm just giving you an example. But this is a good example that if I look at this and I say, okay, well, it's been consolidating. It's been staying within a 15% range. It's now just starting to break out of this consolidation period. It did have a lower low. Let's just say it was super bullish again. Again, just a hypothetical. Well, do I favor buying or selling here? Well, it entirely premium, by the way, when I say buying or selling in this context. It depends entirely on what my thesis is for the move. if I look at this and I'm like, yeah, okay, based on my research and what I think is possible, maybe using prior reference moves, like here it consolidated for a while, started marching up and out. Maybe I'll give it another couple days because based on, again, my breadth of experience, learning technical analysis and studying signals, then I'll take a look at, give it another day, see if it continues the rally. And if it does, then I favor a breakout move to the upside, potentially. Okay. Well, if I do that, then I would not want to sell puts. I would rather buy calls of some sort. Then I have to go through the rest of my trade process to see that it lines up. But this goes back to this. I cannot overemphasize this point enough. I think between these first two, this is probably the downfall of the overwhelming majority of traders. I genuinely would feel comfortable saying that. And you guys know, hopefully, that I don't like giving bad statistics. I don't like saying numbers that aren't based on something. So this is, I'm postulating here, but I would feel pretty confident in that as a measure. Like, I think that's probably pretty damn close is my guess. So I'm going to take a pause on the first two most common option trader mistakes. Anything jump out at you here? Because there's something that jumps out at me compared to your answers from the beginning of the session. It shows me at the beginning of the session, most of you are here looking at individual strategy level decisions. We're talking about the ways that we manage individual trades. But from my perspective, I think this accounts for the vast majority of options traders that don't succeed. Because again, what I can tell you is that if you are good at finding specific profit mechanisms and you're good at measuring, creating signals, understanding the characteristics, your probability for failure becomes minute. As long as you maintain good overall trade hygiene, things like managing risk, as you guys point out, that's massive. You have to manage risk. But you can manage risk perfectly and still fail. If we can't find things that are doing what we think it may or may not do, and then building stuff around it. First two steps. So your action steps here, work in progress, but where we're at so far. First one is for the next, I realize that's right behind my head, sorry. First one here is for the next 3 months. You should create a monthly and weekly learning roadmap. That's your first action item. Now, I would highly encourage you, you don't have to do this, but I would highly encourage you to pop into the Discord and share. Share what you think you're going to focus on. We literally have we have an entire beginners channel, and it's free for everybody. That's in the free area. Everybody can access it. It's completely free. You can join, and then you can figure out if what you're focusing on makes sense. But guess what? Even if you don't want to join the Discord and do that, I'm completely agnostic. I honestly don't care either way. You can go to my website because I literally built it for you. I literally give you a starting point. But the point is to start getting detailed. Reese says, not to sound defensive, but you asked an options question and the answer didn't involve options. No argument at all, though. Yeah, definitely. That's the point, though, right? Is the whole point of asking it in the context of option traders is because option traders forget this shit because they're not thinking about it. That's exactly the purpose of that question, is because options traders become too focused on options and they put the cart so far in front of the horse that you can't even see the fucking cart. So yeah, completely agree with you. That Lauren says, what exactly do you mean by learning roadmap? You tell me. What do you think that means? It's a great question, by the way, but I'm very curious what that means to you. And if anybody else has any ideas on what they think a learning roadmap might be, feel free to chime in. I'm going to try my super cool back pillow thing. So far, the back's been pretty good, but I wonder how this... Oh, Jesus. Nope. That's like way too much. Don't like that. We're not there yet. I'd rather be skiing says a structured process to real an intended goal with success, to reach an intended goal with success, potentially. The steps you take to learn a complex system. So Cedric is on it. So this is a roadmap. And then again, you can get this on the website. And then what I do actually is at the bottom, you can take a look at a more in-depth syllabus. So what I do is I give you a starting point. Again, this is not the whole answer, in my opinion. This is literally a starting point. And the reason why I give this as a starting area is because I do think you need to take the time and figure out what holes you need to plug, right? Because maybe you already understand compound interest. Okay, cool. Then you don't really have to spend a lot of time on that. But my guess is if you, for the next 3 months, decided, okay, month 1, I'm going to start with module 1. And again, I'm just using this as a framework. You can make your own. I'm not saying that this is the best solution out there, comprehensive solution. This is a starting point. You could say, okay, my first goal for this month, and maybe I go faster. Maybe I can get through 2 modules in a month. It's up to you, right? You can set whatever you want. But my recommendation is to set structure and hold yourself to the structure. So you should be able to look at something like this and have solutions for all of them mentally. Whether or not you want to take notes in a trading plan, entirely up to you. I do, but totally up to you. But like, for example, setting financial goals. I guarantee you, if I walked all of you through what I do, the people that are in the mentoring program on the Patreon, I guarantee you, if I walked all of you through that, you would have completely insufficient financial goals. Completely insufficient. And that's not to dig at anybody, but it's just because it's something that we don't think about. We just kind of start moving and we forget that we have to think about this. And some people, they think they have financial goals. But then you ask them, what are the financial goals? Oh, I want to be financially free by the time I'm 40. Okay, cool. What does that mean? Well, I don't really know. It's just to have enough. Okay, cool. What's enough? How much is enough? Well, I don't need that much. Okay, well, that's what you're saying right now. What if you have a kid? What if you have another kid? What if you decide by the time you're 40, you want to enjoy life a little bit more and you don't want to eat ramen every day? Consider that. Right? So the point is, we as traders want to get so far ahead of ourselves down to this shit that we completely forsake completing the basics of setting up an absolute rock solid foundation for what we're trying to do. So again, that's my guess, is that if we went through this in depth, this idea of setting financial goals, my guess is just about every single person in here would have underdeveloped financial goals. And that's not a dig. Hopefully, it's a shot across the bow that it's something you probably need to think about. Probably. Because again, I've done a bunch of these mentoring sessions at this point, and it is universal across everybody. So if that's the case, it's probably generally applicable to a much larger sample. Same thing here. Risk profiles and tolerance. Let's do a hypothetical for the chat. What's your risk tolerance? Just whatever that means to you. What is your risk tolerance? And I guarantee you, for those that answer, there's going to be a common theme. I already know there's going to be a common theme. Vladimir says hi. Tommy says 1% drawdown. Sam Clemens says extreme. Roaring Titty says not good enough. Cedric says if I know the value of a company. Elong Song says medium. Reese says depends on conviction. So what do you guys notice about essentially all of these answers? Paula says 1% drawdown. I'd rather be seen says a percentage of the portfolio based on risk reward of a trade. Cedric is on it. These aren't numbers. If we're talking about risk tolerance, whether we think about risk tolerance as a function of total portfolio risk, what you put on an individual trade, again, it's an open-ended question by design. But there were two people that even loosely defined it. And the other thing I can tell you is that for the people that say 1% drawdown a portfolio, that's essentially impossible to trade. Like if you think about a 1% drawdown on the portfolio, that's almost impossible to achieve, even in the best returning assets. So for the people that quantify it, that's still, it's insufficient. Because if we rationally think about 1% of the portfolio risk, we would be overutilized as soon as we do anything. So when I think about something like risk tolerance, this is again why setting financial goals is so important and why having this in order is essential. Because how are we going to go down here and worry about options if we don't even reconcile with ourselves the way we think about risk and what we're okay with? How does that make sense? It doesn't. And the reason why it doesn't is because most traders skip this entire process of building structure, building a solid foundation. Again, the leading mistake I see options traders make, and again, I don't say this from a holier than thou perspective. I did this exact fucking thing. We all do it. I didn't do this in the beginning. I didn't think to do this. I didn't know to do this. But now looking back at it, I realized that as I was trading things, when I had the largest percent drawdown on my portfolio, I can guarantee you it's because this. I did not strongly consider my risk tolerance and actually think through how I would feel in different risk on scenarios. So this is, again, a generalized starting point that I think new options traders can leverage for themselves. This is not comprehensive, but I think this is a good starting point. Then we look at, we have our roadmap. We know what we're doing now. We know what we're focusing on. So now what's our next action item? I gave you your first action item. The first action item is for the next 3 months, define what you're going to learn or focus on monthly and weekly. Again, I gave you a starting point. I literally give you an example. You don't even have to make your own. You can make your own. I encourage you to, but I'm giving you something that you can start with. So then the next part of this is for every single thing you think you're going to trade, you start here. We need to create a trading plan in a trading log. And in that trading plan, we're going to start by listing all profit mechanisms you can think of. And again, this is all free game, right? Like this is what I do with the people in the mentoring program. And the reason is because most people, if I ask them, talk about a profit mechanism, it's such a broad question that a newer trader doesn't even know how to define that for themselves. So I'll help you. What are some basic profit mechanisms you can think of? You guys start. You guys tell me first, and then I'll give you some ideas. I'd rather be skiing says, what do you mean by profit mechanism? It's a great question. What do you guys think? So for I'd rather be skiing, that video is for you. And let's see. Reese says shares. Joey says stock goes up. VRPP. Okay. Cedric says I look at undervalued company with a turning story and use options as leverage. Okay. Paulo says directional, selling premium, volatility. Vladimir off Putin says price movement. I'd rather be skiing says buy low, sell high. Reese says long calls, short puts. Cedar says theta decay. So what does this say here? Might be hard to see, so I'll read it out loud. What is the specific mechanism that makes money? What is the specific mechanism that makes money? So, for example, Roaring Titty says, look for news catalyst. To me, that's a signal. Something that's providing some sort of news catalyst is a signal. So Roaring Titty, expand on what happens. So let's say, Roaring Titty, that there's news that comes out and it provides a catalyst. Then what happens? A very important step in this process. Brad is on it, but I'm waiting specifically for Roaring Titty. Check out the chart for volume. Nope. This is exactly why I want to work through this example. I want to make sure that this is crystal clear. So Roaring Titty, we have news comes out that provides a catalyst. Then you check the chart for volume or whatever, and you see volume expanding. So far, does any of that happening equal you've made money? I think we're going to do boneless wings tonight. I'm feeling some Buffalo Wild Wings. Cedric says nope. Cedric would be correct. I'd rather be skiing says not really. That's also correct. Okay. And Roaring Titty confirms no. Okay, great. That's perfect. So now Roaring Titty says, but you have to think through your trade before you do it. Of course. Absolutely. Absolutely. Again, stay with me here. We're talking about profit mechanisms and defining profit mechanisms. So what I'm getting you to do is called a root cause analysis. So Roaring Titty, keep following me here. You said news catalyst that then leads to volume. Both completely fine. But we both agree that that doesn't actually equal profit yet. So then keep going. Walk me through what gets us to profit. And in the meantime, cheers, I got to take some acetaminophen. So in Roaring Titty scenario, we have news, we have a catalyst, we have volume that's expanding. We have faith in the titty. Let's take a look at this. Let's take a look at Nike. So Nike had a new CEO. That's news, right? That's a catalyst. And then Roaring Titty, to your point, we see volume going up. So there's your volume. The news itself doesn't make you money. Volume expanding doesn't make you money. So then what happened here that would actually make you money? It has something to do with the chart itself. And think about it. If you put in $1 and the news breaks, does your dollar change? It doesn't. Roaring Titty says support and resistance. Close. That's moving in the correct direction. The thing that makes you money is the stock moving. So let's use an alternate scenario. Let's say Nike announces a CEO. Let's say stock volume goes up, but it's highly constrained. Buyers and sellers are on top of one another. You have news, you have a catalyst, you have expand in volume. You might not actually make any money. Or you could have news, you could have catalyst, you could have an expanse in volume, and it could go down. You could lose money. So what I'm trying to do is get all of you to think about this specific mechanism that leads to making money. And we'll go into a couple examples. Mel just got home, so I had to make sure I let Thor run out and go run over to her. So first, let me take a pause there. Roaring Titty. Does what I say make sense? My guess is you're inherently thinking of that. Like, I don't think I'm saying anything that's necessarily revolutionary. But hopefully the point that I'm driving home is the requirement to break things out and down into these requisite pieces. That's my goal. I'm hopeful that that's the point that you will take away. So when we think about a profit mechanism, it is how something functionally makes you money. So let's think about a few of them. We just covered one of them. So we have something that can have, let's do profit mechanism. First one, easy. Price direction up. Another one, price down. Another one, volatility. Up, down. VRP, or relative. Roaring Clitty says if something is trading sideways, you can make money selling options. You can. And the way that you do that is either through volatility, or you can absolutely classify that if you would like. You can absolutely do time value. Now, your time value stuff will almost always have a volatility component, but you can absolutely break out something like theta decay. Cedric says yields. That's exactly correct. That's another very good one. This can be dividends for anything. Stocks, ETFs, bonds, they have yields. So all of these are absolutely profit mechanisms. Now, Cedric says merger. Merger itself is not a profit mechanism, right? Because again, and this is why this point is so important, is because mentally we conflate things, right? A merger can happen that doesn't do anything. The stock cannot move. That's not the actual mechanism. That's a signal. Same thing with Roaring Titty, right? So if we think about signals, so literally just get rid of this and think of it this way: profit mechanism signal. What you all are onto now. Captain Chris says, yo, I'm in public and everyone keeps hearing you say titty. Yeah, man. Well, we have the titty in here. So I'm a say her name loud and proud so that everybody there around you knows that we have roaring titty in the house. It's actually, essentially, it's like vital for our operation here to acknowledge titty. And I think everybody here has a strong affinity for titty, as we should. So now let's think about what, funny enough, titty. Let's think about what titty said. Share buyback. So what happens in a share buyback typically? And as Off Putin says, not all buybacks are created equal. Ask Chewy holders, which, that's something in it. But it's fair. So anyways, let's talk about a share buyback. Usually move price up. I'd rather be skiing is on this like white on rice now. So we see price move. That's what that means. So this is the process you have to follow. And again, I can tell that not everybody has it down still. Because like Cedric here, and this is not to pick on Cedric, we're all learning. But here Cedric says it's a change in demand. It is a change in demand. But again, a change in demand is not a profit mechanism. A change in demand is simply a change in demand. Demand can go up, demand can go down. And if we don't see anything, then price doesn't inherently have to move. Same thing with like a merger arbitrage. Price isn't dictated to move in a merger arbitrage. So the way I want you to think about profit mechanisms is hyper specific. I want you to think about what a trade does that actually makes you money. So let's take a look at some examples and see if we can dial this in. Let's say, perfect. Let's say Nike's here. A key. And let's say, for a change of pace, I, Eric, for once, actually time the market successfully. I enjoy these hypotheticals. It's a chance that we can play fairy tale. So I can be whatever I want to be. And in this fairy tale, I want to pretend that I actually traded something with good timing. Really nice. So, in this alternate universe that in no way mirrors reality, I chose to sell a put here on September 11th. Sold a put. Then Nike goes on. So we fast forward 1, 2, 3, 4, 5, 6, 7 trading days. 7 trading days forward. What's my profit mechanism here? Now, I don't want to be mean, so I'm already going to give you a hint. There's more than one. There's a primary and a secondary. I never give hints like this, but I really want the point to hit home, so I'm being a little too soft. Cedric says stock going up. IV change. Lance says good timing. Rowan Clitty says stock up, theta decay. Tommy says time decay. Underlying price moves away from the short strike. Joey is exactly correct. Joey has the most comprehensive answer. Joey says main is underlying movement. That's absolutely correct. So the primary profit factor here is going to be delta. The movement of the underlying, completely correct. So the first profit mechanism is price movement up. The second profit mechanism is long theta, and time has passed. The third profit mechanism, whether or not it happened, I'm not sure, we could take a look, is if volatility changed. And in this case, volatility would have gone against us. So that wouldn't be a profit mechanism. And it doesn't surprise me. Let's use this as a great foundation for a hypothetical, not even a hypothetical, a practical question. Why is volatility expanding here? The stock price is going up. Normally wolatility contracts when stock price is going up. Look carefully at the chart because your answer is there. Why, oh why, is volatility? Brad says because the gap up with news. Nope, that's not it. It's good news. So Joey says it went up more than expected with more volume. Nope, not it either. Can you guys, let me see if you can see it on the screen. Yeah, you guys can see it. I was concerned that it might have been hidden, but it's not. Roaring Clitty says big move up and maybe also a larger range during the day. Nope, not it either. Reese says sudden move. Nope, not it either. I'd rather be skiing says volatility increase with price movement. Nope. Roaring Titty says volume profile. Nope. Roaring Clitty. Roaring Clitty gets a round of applause. So I need to find my little trophy for Roaring Clitty. Fuck. Roaring Titty, you can get one too anyways, because why not? But it was meant for Roaring Clitty. You get plus one fake internet point. Roaring Clitty says we're a team, it's chill. Yeah, it's perfect. I guess you guys can share them too. This is the art of trading. It's learning how to decipher all kinds of market information. Now, for a new trader, you probably wouldn't know that, and that's okay. You're not supposed to know all of it up front. You're not going to. But that's exactly why volatility was increasing, is because we're getting closer to earnings. And again, as you surround yourself in options more, you will learn more things. And this is one of those things that we typically will see volatility, implied volatility, expand leading into earnings starting about 2 weeks out. It's common behavior. I know it's going to happen more often than not. So, fun fact, let's talk about profit mechanisms. Is there something there? Any ideas? What profit mechanism exists based on that phenomenon I just told you that I know implied volatility tends to expand about 2 weeks out leading into earnings? Long vol. Bingo. Reese is correct. 100% correct. So the way that we think about profit mechanisms is the specific thing that leads to making money. Now, what's the signal? Well, the signal in this case is knowing that earnings is coming up in a few weeks and volatility tends to expand into earnings. That's my signal. The profit mechanism itself is the movement of implied volatility. Roaring Titty says long vol, long volume. Nope, it's long. In this context, it's volatility. Most of the time when you hear people say vol, it refers to volatility, but sometimes it can mean volume, but that's less frequent. Normally you'll see, it's context dependent, but normally you'll see it as volatility. Roaring Clitty says if you take earnings out of the equation completely, would the gap up not increase vol? Not necessarily, no. Yeah, it doesn't mean that it would or wouldn't. We can't really tell because there's other things at play. So prime time example, it gapped up here, right? But I can tell you that 30-day vol went from 27.7963 to after the gap, it went to 27.64. So 30-day vol contracted. And then if I take a look at 7-day vol, it went from 25 to 23. So this is an example of a gap up and vol went down. That's why it's not a discrete answer, right? And that's why I can tell you definitively that the behavior largely is going to be attributable to earnings. Does that mean that the gap up didn't have an effect or the news didn't have an effect? It absolutely could have. I can't decouple those entirely. But here's the other thing I can show you is that leading into this gap up, do you notice the slope of volatility? And again, it's these yellow lines. It's positive sloping. So even before this news broke about Nike CEO being replaced, it already, even as it was going up, volatility was expanding. And again, from a practitioner standpoint, from experience, I know more often than not, if the underlying is going up, volatility tends to contract. It doesn't always, right? That's not an absolute, but it tends to contract. So here, I see something that's going up and I see volatility going up. That tells me something's up. Don't always know what right out of the gate, but something's going on. And in this case, I can clearly see a few things, but a big one of them is this earnings on the horizon. Cedric says, I'm confused. What is the difference between IV and volatility? There's no difference. They're different things related to the same thing. This video is for you. So Cedric, that video is all about volatility. So it's going to talk about all different kinds of volatility: implied, historic, forecast, realized, future realized. It'll break down vol entirely. So that's the video I just shared there. Cedric says, so it's a profit mechanism, right? Is what a profit mechanism? Be specific. IV. Is it? Again, be specific. What IV? Changes in IV. Cedar coming in for the alley-oop or the assist. Correct. Changes in implied volatility certainly would be a profit mechanism. So you'll notice here in the profit mechanisms, I literally already had those written out for you, right? Volatility, up, down, relative volatility plays. This is not a comprehensive list. There's tons of things, relationships, correlations, tons of things. Now, the last thing, though, that I want to highlight on this idea of profit mechanisms and their corresponding assessment is that, do you think all price up profit mechanisms are built the same? And we actually already did a preamble to this a little bit earlier. So you will actually already know the answer. Reese says no. Cedric says no. I'd rather be skiing says no. Exactly. You guys are all spot on correct. So then what does that mean? If all price up profit mechanisms are not built the same, what does that then tell me? Cedric says, depending on the risk you take, that's not wrong, but that's not what I'm leaning towards. It tells me something very important about this step here, this next step. Reese says we have to tailor the one that fits best with the thesis, maybe. Zoom up one level. I think you all are down one level below where I want you to be. Joey says it's a choose your own adventure. That's not wrong. Roaring Titty, Cedric is on the right path. How clear the signal is, that's not correct, but it's the right path. Roaring Titty says depending on your trading goal on what you pick, that's correct for sure, but zoom up one level for you as well. So if not all profit mechanism price up in this example are built the same, what does that tell me about the signal? Reese says, IDK, what zoom up a level means. It means take your thought level from where you're at to a higher level thought. So kind of like a broader thought is the way to think about it. depending on how the movement moves. Now we're getting much closer. We're getting much, much closer. Lance is leading us in the correct. There we go. Joey is on it. Joey is on it. Spot on. Joey says how to differentiate between different samples. That's exactly it. So what this means is if I'm thinking about price going up, what's one quality I can think of? I can think of something like positive drift. I can think of things like momentum. I can think of things like breakouts. I can subcategorize some of these into things like Pt15. Tommy, perfect. I can think of things like trend. I personally would classify those in momentum, but I think that that's completely fine. Roaring Clitty says short squeeze. Absolutely. That's literally a fantastic one. So do you see my point here? So what I just gave you is homework. This is the next action step for you as a beginner, advanced, wherever level you're at. Doesn't matter. You still have to do this. So we need to open up a Word doc, start a trading plan. We need to open up an Excel sheet, and we need to create a trade log. And we need to start outlining all of these different profit mechanisms. And we need to start thinking about the subcategories of them so that we can assess signals. So here, the way that I'm going to look for positive drift is different than the way I'm going to look for momentum, which is different than the way I'm going to look for breakouts, which is different than the way I'm going to look for post-earnings announcement drift. These are different signals or characteristics that qualify this mechanism. So then I need to tie signals to all of these different variations of the profit mechanism. This is a specific profit mechanism. Price direction up with positive drift. Price direction up via momentum. Price direction up via breakout to the upside. This is a defined profit mechanism. It's very specific because now I can say, okay, I'm trying to look for things that are going up and I'm going to look between things that are exhibiting momentum or breakouts. How do I find things that move like this? That's where we start playing with signals. Maybe it's something that crosses above a 50-day moving average. Maybe it's something that's been consolidating for the past 10 days, but then it starts to break above the high of the consolidation period. Lots of different ways to go about it. And this, again, is trading. Guess what? We still haven't even talked about options. We've been going for, 90 minutes? And in the 3 most common option trader mistakes, I haven't even touched options yet. Because you have to put first things first. Doesn't matter if you're an options trader, a trader, swing trader, day trader, value trader, whatever you are, this all has to happen. And then depending on how comprehensive of a trader you want to be, then it might be more or less. That's all there is to it. Cedric says, I used to just look at value. This is so complex. Yeah, I mean, that's the beauty of trading because, again, like while somebody like you might be a value investor, while the market's going down, I'm making money. That's the difference. That's why there's so much work that goes into this, is that the whole point of doing this kind of thing is so that you can build an approach that meets your objectives. I've had 2 negative years my entire trading career. The worst year was down 4% in change. It was my second year trading. That was my worst down year. I don't have some sort of crazy impressive positive return. I have a good return, but I've built a system that moves me in the exact precise direction that I'm trying to go. So to Cedric's point, if Cedric enjoys doing something like, value investing or, whatever the approach is, that's totally cool. And if that works well for them, that's totally cool. It's like a very Warren Buffett-esque style. But again, if I purposely compare my returns to the S&P 500, and then I have in my tracker Warren Buffett's returns as well. Specifically Berkshire, we bucket it up to Warren Buffett, but it's not just him. But the point though is that I definitely out-return Warren Buffett, and I'm not a better trader than him by any sense. He has scale that he's dealing with and yada, yada, yada. But I do have a better return than him. And I also have a better return variance than him. So the whole point here is to develop something that works for you long-term. Roaring Titty says this hurts my brain. I know, it's a lot. So then, that'll probably hurt your brain by zooming it in. So then let's simplify it a little bit. We can start very, very simply. And then maybe this will make it a little more palatable. So I'm going to group these so that I don't completely lose them. Let's take a look at a hypothetical. So let's say, because Roaring Titty is brave, and she said this hurts my brain, which is completely fair. It's a lot of shit. So let's start from a very simple approach then. Lack of structure. I'm a new trader. The first thing I'm going to focus on is the fundamentals of the markets. So for the first month of my learning experience, I'm going to focus on these. That's the first month. That's what I'm going to focus on. So talking about the outlier big four, don't even worry about it. Doesn't matter yet. I'm going to focus on just this. Then after the first month, or in conjunction with the first month, depending on your pace, I'm going to focus on this. Don't care about the outlier big four. Doesn't matter. I'm going to learn about the markets for the next month. Now, I'm going to start getting my house in order. And when I say my house, it's the proverbial trader's house, in having some organization to make sure I can track notes, track some ideas. That's the next thing I focus on. Then from here, I personally would gloss over these common trader shortfalls, trader behavior, decision-making. I would just gloss over these. Know that they exist. And again, you can pop on my website. It'll show you trader decision-making, cognitive biases. You literally can just run through and say, okay, I at least know that these things exist. That's it. So these two here can take you moments, not long. Then we start getting into the actual components of trading. So now is when we add the next layer. So essentially, the first 2-3 months, doesn't even worry about this. Once we have a fundamental understanding of the markets is when we get into this. And I would start very simple. I know broadly that price drifts up. I know that. Okay, cool. What else can I see in a chart? What else can I notice about the market as I just poke through it broadly? Well, another thing I notice is there's kind of clear relationships between different things. Won't know what they are in the beginning, but I know that there's these different kinds of relationships. And I also know that there are lots of different kinds of securities that will be based on my earlier lessons on the market writ large is when you'll learn that. Then I'll kind of poke through here and I'll say, okay, well, there's different sectors. The market's set up in these different ways. But I notice that price tends to go up, price tends to go down, price tends to go up, price tends to go down, tends to go up. So price moves. Okay. What are some of the things that I can eyeball about these movements that might be interesting to me? I don't know yet, but I'm going to just take some ideas. So the first idea is, again, I know price drifts up. This is literally called positive drift. And it's an equity premium. Then I just start looking at things and see what I can come up with. So the other thing I just identified with you is I can see price goes up and down. And from a trading perspective, I know that price will do the opposite of whatever I do at a given point in time and make me wrong. I also know that one. So price goes up and down. So literally what I'm doing right now is I'm starting this process right here. That's it. That's literally the first steps as a trader. Roaring titty. This is it. So all of that other stuff I'm showing you gives you way more context on things to look at, focus on, so on and so forth. But this is where it starts. Then we get to learn about options. So the next step after having a general understanding of profit mechanisms, there's subsequent signals, then we get to start playing with structures. And we get to learn about options. This is where we learn about options. This is where we learn options 101. This is where we learn options 201. Down here. All of this starts now in this. Roaring Titty says, but I've already began trading options. Can't unring the bell. You can't, but you can stop at any point and then you can start where you should. And that's one of that we all of us traders have these exact trading scars. Because most of us do just start. It's about as common as it is. It's what I did. It's what we all do. But you can absolutely pivot and just start doing the right thing starting tomorrow. Exactly what I would do. So this is the next part of this process. Once you get down to outline fitting structures, you don't know what structures are. So now we have to learn options. This is where we learn options. Then we build strategies, optimization. That's all future state stuff. That's not stuff that beginners have to worry about too much. This is where we learn options. So now you might be asking, well, Eric, what's the third thing? We've gone through two things so far. What's the third thing? Any guesses what the third thing is? The third most common option trader mistake. We got to swap out our spin drift. Don't worry, we got plenty of mango orange. Reese says no more guesses. Joey says ill-fitting structure. Tommy says sounds like to be successful, the whole process has to be completed. I honestly wouldn't say that personally, Tommy, just because there are freaks. Like there are people that cannot do any of this and do well. The way I look at it, and I purposely would call that out because I would never want somebody to think that like what I do is the only way. But what I can tell you is like for somebody that's not super intelligent, going through this kind of process is really important. And the other thing I would feel very confident in generalizing is that somebody who goes through this kind of process is probably light years more likely to be successful than somebody who doesn't. So I would feel really confident with that. Tommy says not looking at downside risk management. That's fair. I see saving. I think that that's good. I don't see the answer yet. So let's think about it. Practicing is really good. Now, if we think about where we would practice, probably somewhere in here, hopefully. At least that's where I would practice. Let's think about it. Let's say that we have two traders. We have trader A and B. Cedric says, how are you going to capture the profit mechanism? That's step 3 over here. We hit that entirely during the big 4 trade process, right? That's the whole point of that. Brad is the closest. Think of a hypothetical. We have two traders. Both of these traders follow this process. What will differentiate these two traders from one another? They follow the same exact process. They do the same, they go through these same steps. What will differentiate them? There we go. There we go. I'd rather be skiing is spot on. Psychology. It's literally you as the trader, you as the button clicker, you as the researcher, you as the risk manager. It is not taking the time to understand you as a human being, your tendencies, your weaknesses. We don't like looking at those. We don't like confronting our egos. All of us have one. Most of us spend very little time analyzing ourselves or our actions. So, for example, and be honest, it's an anonymous poll, but here's my question. Damn it, my question's too long. I'll just add a word here. And then I have to spell you with a U. All right, there's your poll. Do you have a comprehensive trading log right now that breaks down every single one of your trades and your entire performance by strategy for the last 52 trading weeks? I see 13 votes and I see 73% no. I would even challenge the people that say yes. For the people that say yes, if you're willing, email it to me. Email it to me now. I won't say who sends it to me, but I'll just look at it. Because my guess is it's probably not very comprehensive. That's my guess. I could be wrong, and I hope I'm wrong. That would be fantastic. But that's my guess. My guess is the 30% that have a trade log that analyzes their performance comprehensively for the last 52 trading weeks. My guess is it's probably not quite comprehensive. I'd rather be skiing says, I'm sure you're right because we may have a different idea about comprehensive. Potentially. We might have a different idea. But here's the way that I would reconcile that is I would ask you basic questions and see if the trade log can answer those questions. So that it's not a matter of nuance of, oh, you need to have return on invested capital here. Like, yeah, maybe it's useful, maybe it's not. It's not that kind of thing that I would question. My response is, or my sentiment is predicated on if I asked you something like, which of your strategies performs best in a bullish market? Something very simple like that. Some people might be able to say. My guess is if I look at the trade log, what they say might not align with what's in the trade log. That's my first guess. The second guess, I would imagine, is that if I actually asked more important questions, that we wouldn't be able to answer them. And again, it's not necessarily down by memory, right? Like that's the whole point of having a trade log is you don't have to remember, but could we reference somewhere in your trade log by strategy for the last 52 weeks, the total number of trades that went on, the number of winning trades, average winner, max winner, lowest winner, same thing for the loss side, average number of wins per week, average number of losses per week. Could we like extract data that could then inform our decision making meaningfully? And my guess is even for the 27% that say yes, they're probably missing a lot of really important details. Again, I hope not. I genuinely hope not. But the reason why I mention this is because this goes into the faulty mindset. Because again, for the 73% of people, the other thing I think about is if I asked that 73% grouping, so if you answered no to this question, do you think a trade log would benefit you? Do you think having a record of all of your trades and kind of corresponding important details, do you think that that would be beneficial? Yeah. So like everybody knows that this is good. Everybody knows that this is good. Yet we don't do it. We know it's good and we choose not to do it for lots of different reasons. I'd rather be skiing says it's the only way you can sometimes find what's broken so you can address it or fix it. Yeah, exactly. But then again, going back to I'd rather be skiing your earlier question of I've gotten lazy. So if you're telling me that you have this tool that you know can fix what you're doing, then why would you get lazy about it? That doesn't make sense. That doesn't jive. So what I'm highlighting here is this is a massive bucket that we all gloss right over. We're worried about what new regulation is coming out or what senator is cheating based on their position and insider information. We're worried about bitching about the market makers and what we think they may or may not be doing. We're worried about a lot of shit. And what I find fascinating is as traders, we spend so very little time worrying about the very one thing we can control. Ourselves. The only thing you can control as a trader. And we skip right over it. So here are, in my opinion, the three most common option trader mistakes and action steps on how not to do it. I gave you the outline here for lack of structure to create your own structure. I gave you the way to start thinking about building profitable strategies that are centered on defined profit mechanisms and the ability to measure signals that help us find those profit mechanisms. The third and final thing that I'm showing you is that you have got to take time to start introspection. You have to look at yourself and you have to understand your tendencies. An easy way to start this is, again, literally go through my website and see what you think might align with you. We did this yesterday, actually. Somebody asked what I think my largest cognitive biases are, and we ran through it. So, disposition effect. If you have a trade log, you can answer this. If you don't have a trade log, you literally can look at your brokerage statement. It's not going to be as informative, but I could still see it straight from a brokerage statement, no problem. That's one of the things that I do, again, when I'm talking with people about this stuff. Because what you'll notice is that I think I have one in here. Do I have one in here? Whoa, I have a giant blind spot. Hold on. Whoa, I'm literally about to have to edit this. So this is now going to become 24 trader decision-making cognitive biases. As you look at this, actually, do you have an idea of what needs to be added here? And I'll zoom this out so that you can see most of them. So we can get past the disposition effect, high win rates, can't go broke taking profits, Goldilocks, skill gap analysis. This is interesting. But there's a really important one that's missing. Yours was 15, no? Mine was a bunch of them. So I think for me, the ones I identified were anchoring, hindsight, availability. I think those are the main ones. Recency. That was another one. Don't drink and trade. Maybe, I mean, that actually could be a solid strategy. Maybe somebody would crush it with that as their approach. Nope, that's not it. It's a good guess, though. But not quite correct. I'm literally updating it so that you can see real time what it is. So, and I think that this one is probably really, really common, actually. Self-accountability. I think that that's fair. I see Cedric says 12, 22, 23, 20, and 13. I mean, I imagine it's probably most of these for most people. Tommy says expert info bias, thinking your information sources are the best. Yeah, I think lacking the ability to like objectively evaluate a data source is really, really important. Like really, really important. So here is the updated version. And I don't think anybody guessed it. And it's kind of a slightly different version of what like the true definition is, but I think it applies here. So if I hit refresh, it should say 24 now. There it is. This one. So the one that I think is probably really, really common is when a person fails to objectively evaluate something. And there's a cognitive gap between their perception of reality and what reality actually is. So cognitive dissonance. So the idea behind cognitive dissonance, and I guess I can get rid of bias if that doesn't need to be there, is that we essentially fail to connect reality to what it is. And it's really easy to do this. It's really easy to do this. Off Putin says this is much more rigid and organized than I care to be. Yeah, it's I don't like this either. To be like, it's work. Nobody wants this. But what I can tell you is that something like this is a primary driver of why I've been successful as a trader. Hopefully will continue to be. We never fully know, but I'd like to think that I'll be able to continue on the path. And it's because of taking the time to look at all this stuff. But most people don't like to look at this stuff because it's uncomfortable. It's a lot of work. It's not fun. But yeah, I totally feel you. Cool. So that's the main part of the session. Is you now have an understanding, at least from my perspective, the 3 most common option trader mistakes. You now know what they are, how to overcome them, and then you actually have an approach now on how you can work on them. I'd rather be skiing says sent one log in journal. Yeah, I'll take a look. I'll literally look right now. Reese says when you go through trades, it seems easy. Of course it is. Yeah, of course it is. Because what happens with a trade? The trade is simply a culmination of an idea. All of the work to be a successful trader is done light years before you ever click a button. And I say this openly and genuinely. Trading, the actual process of trading is fucking easy. It's mindless. Because at that point, all of the work is done. All you do is apply everything else that's been done. But all of the work, literally all of the work, is done before ever pressing a button. And it's exactly why good trading is effortless. Good trading literally is effortless. But to get to that point is very difficult. Okay, so for I'd rather be skiing, one of the first questions I have for you is, what was your maximum portfolio risk? So let's say it looks like you're mostly looking at shares, which is totally cool. And I see that you have total risk as a dollar amount. What's your total portfolio risk? Like, let's say all equity trades and I trade 2% of allocated capital per trade max. Yep. So for example, though, my point is when I look at this, well, one, it doesn't look like you do that because you're holding equity. So you can't risk 2% of capital max per trade if you're holding equity. Why is that? Why do I say that? So if you tell me you risk 2% max per trade, and I'm telling you, if you're holding equity, you're not doing that. Why is that? Cedric says no leverage. That's not it. And also a giant shout out to I'd Rather Be Skiing for being brave and sending this in. So first thing I'm going to do is hook I'd Rather Be Skiing up with 3 fake internet points, because he's the only person that took me up on that. And that's not easy to do. Have somebody look at your stuff and give you feedback. It's very vulnerable. So straight up props to you. So now, but why is that? Well, let's take a look at an example. I'm going to save this, and then I think we can probably close this for now. Cedric says, if you're trading equity, it's harder to manage risk. No, not harder necessarily, but there is a dynamic aspect to it. So I don't want to, I'd rather be skiing. I'm not going to dox your trades and stuff. I'm just going to pick an example though of something here. I'd rather be skiing says, I used position sizing. It was 2% loss. Tradable capital, so not 2% of all capital, is much smaller than that. Yeah, that's okay too. That's not so much my point though. My point is why does that not matter? Because you're risking more than that. So let's say you like Nike and you buy Nike here and you're going to risk 2% of your capital on Nike, right? So we're going to do 2% of our capital on Nike here. Well, what happened? Something very specific happened here that does not care about what we defined as our risk. It gapped down. There's nothing to be done here. So you got in, just proverbial. Again, I'm not doxing any. I don't even think this is on your list. I'm just picking a random ticker. But we're defining it as 2%. But it gapped down. We have more than 2% risk on. If we use a stop, it doesn't matter because this blows by your stop because it's a gap down. There's no controlling this. So now, again, let's play the proverbial. When I ask how much portfolio risk is on at a given point in time, then we obviously can have what our perceived risk is, and I think it's completely fair to use the stops, right? Roy Clitty says, what if only 2% of your capital is in the stock? There you go. Literally the exact point I'm driving towards is I think it's completely reasonable to use what you anticipate getting stopped at. Because here's the other thing. Let's be realistic. We can't make trading rules based on stuff like this, right? Because this happens. So then how do we actually define the total risk of a portfolio at a given point in time if we're trading something like an equity or an option that you can't get out, or even a future that there's periods of time that you technically can't get out or don't have offsetting positions is by the size of the position. But then the total portfolio risk is still different. So I measure a few different things, but one of them is absolutely, I use the most severe overnight day drawdown, and I just leave it in the sheet as a reference. So like, for example, what we can do is we can say, all right, let's say for the individual stocks that I'm trading, let's say I'm trading Nike. I'll go back and I'll say like, what's the worst overnight move that I've seen? And this is if I trade something a lot. I wouldn't necessarily go through all this hassle if it's something that, like I just anticipate trading once. But from an options trading perspective, you tend to do the same stuff over and over again, like in the same names, because there's not that many. So I develop a footprint for all of them. So what I'll do is I'll say, okay, over the last 10 years, what is the biggest overnight gap the stock had that I'm trading? Now I at least have a reference. Again, it could be more than that. The worst days typically are ahead of us. So maybe I can buffer it a little bit, add a little bit more, but I at least have an idea of the total portfolio risk. And again, I personally wouldn't use that as my planning factor, but I would absolutely want to know that in my trade log. Because again, what is a terrible scenario is if we don't even think about that, and for whatever reason, there's a giant global macroeconomic event that causes just widespread market panic. And then we have 15 trades on that are sized on a presumed 2% max risk, but they all somehow, again, highly unlikely, but let's say not even all of them, let's say 80% of them gap down 10%. That's not that crazy to assume. That can become a massive problem if our entire planning factor is on a 2% that we think we're going to control with a stop or with an exit or whatever. That's something that I think belongs in a trade log. And again, you don't have to go through that process with every single ticker. You can figure out what's the worst that you've seen. And it doesn't even mean that it needs to govern what you choose to put on, but it should be known. That's an important part as a trader, is just objectively looking at information. As long as it's known and understood, then that's okay. Because again, I don't plan like that myself. I do not plan all of my trades based on the worst overnight move it's ever had in its entire history. I don't do that, but I'm aware of it. So that as I'm sizing things, if I'm coming into a market period that for whatever reason I perceive as slightly more volatile or whatever's going on, maybe I'm a little more conservative with where I choose to manage or process my total portfolio risk, just because of that context. Now, what I'm highlighting here that I want to be very, very specific. This is like the most nuanced little branch you can start going out on as a trader. But the reason why you should at least be aware of this nuanced little branch is because the probability of this branch snapping and you falling is very low. It's very, very low. The probability of having 30 positions on your portfolio opening up and 20 of them are down by 10% on a gap down, it is so low. It's not zero. So let's say that you think you're putting money into your trading account and you're like, I don't need this for 5 years, I'm okay. And you go through that experience because you're aware of it, then you can come out just fine. It's not necessarily the worst thing ever. But let's say that you're trying to save up for a down payment on a house and maybe you want your money in like 3 years. Then you open up your platform and you see that happen. I guarantee you, your decision-making capability is completely fucked. It is going to be entirely compromised because you would have just gotten punched straight in the forehead from something you didn't see. And now you're trying to process the fact that your down payment is now gone because of this drawdown that you didn't see happening. So again, very, very niche, nuanced, super low probability event, not what I would use as a planning factor, but it should be something that you should be aware of at least. That's what I think about here. So yeah, just a couple ideas on that. Now, I mean, my dinner's not here yet, so I'm happy to keep going. We can dive into really anything that you guys want to hit. I have a generally open agenda until my B-dubs gets here. I'm actually pretty stoked for some wings, not gonna lie. Anything that you guys want to talk about? And then I'll get caught up on the chat. Brad says, I left a comment on the other video, but are you able to check out the Unity calls today? Several 5K buys for 8 million premium paired with swaps, GME a lot. How do we know that they're paired with GME? Just out of curiosity. Day Swag says, I'm appreciating the Bloom's taxonomy for learning objectives. What does that mean? I don't know what Bloom's taxonomy is. What does that mean? If I look this up, am I going to be... Do I not want to look this up? Brad says swaps are public data. No, I'm fully aware that the swaps are public data. I'm specifically asking about the relationship with GME. Like what when you're talking about the pairing. What is this? Whoa. I literally have never heard of this. This looks old too. Like I see older graphics for it. What is this? The original commonly referred to Black's taxonomy created by Bloom in 56. Yeah, it looked old, just the stuff. As you travel up the pyramid, the level of complexity increases. Yeah, I love that. The framework is important for designing learning experience because it helped the instructor identify, classify, outline what they're expected to learn in the course. I love this. Yo, this is cool as shit. Yo, who showed me this? Day Swag. Thank you very much. Thank you. I literally have never heard of this. This is so cool. This is so cool. Remembering, understanding, applying, analyzing, evaluate. This is so cool. This is great. Oh my God. I gotta do something with this. This is so cool. Because this is exactly what trading is. Oh, I love this. Dude, thank you so much. Yeah, Day Swag. We got to hook you up. We're going to give you +4 fake internet points and then a dab. Because that is super, super cool. Very cool. Thank you so much for this. I love this. You have like, I don't know if it comes like, I love learning new shit. And this is like a really cool one to me. And I think that this kind of framework is such a great reference for people. Like when you're learning about something like options, like this is something I should be integrating. And I apologize for being ignorant to this because this is like such a great way to frame a lot of these things that new options traders are trying to learn that like I literally never knew existed in this format, which is such a perfect format. Like understanding, being able to like reiterate something you've heard, understanding the basic concepts, knowing how they work, understanding how to tie them together, then being able to come up with some sort of perceived information from the things tied together, and then innovating. Like I literally love this. This is so sick. Giant fan. Thank you very much. Big fan. I'm going to find a way to start integrating Bloom's taxonomy more because that is, I think that's like a really good reference for people to think about like what they should be focusing on. Yeah, that's so sick. I'd rather be skiing says I never saw that before either. Yeah, literally. I've never heard of that. And that's so cool. Like literally so cool. Big fan. All right, back up towards the top though, because I think there's a couple others. Reese says, I'm at whatever stage in the journey where I'm questioning why I own shares at all, besides the fact that they don't expire when I could express my disposition through options, which are cumbersome. Yeah, well, I think that that's, you kind of outline it, right? Like when you trade options, you add complexity to what you're doing. So unless there's a reason to add the complexity, then that's how I personally would arrive at the answer of, is the option the correct vehicle? But again, going back to the original principles, we first need to define and have a profit mechanism that's in mind. And then depending on that, we can determine, you know, what makes the most sense. If it's something like using options because we want leverage, or because we want exposure to volatility, or because we want something that collects theta, like those are common reasons to trade options. Equities themselves are just much simpler products. So I think that's essentially the way that I would navigate through when it makes sense to hold equity versus options. I think that that's completely fair. Paul says, do you think DJT could have a short squeeze? Well, let's see. We need this. It doesn't look like it right now. It's only shorted 11%. Days to cover is super short. It's less than like 4 days. Yeah. So could it happen? Sure. Like things definitely could go down, but that doesn't look like something I would consider a candidate. So I think I have a video on squeeze. Let's see. So this one's more about, I don't know what this one's about. Maybe that one has something that's useful in there. I don't really know. But yeah, I don't, to me, like as I look at this now, it doesn't look like it's something I would expect a short squeeze in personally. And then I think there was a couple other questions up at the top. Off Putin says, have you ever considered doing an AMA on Reddit about trading options? Not really. I mean, I would be happy to. The AMA thing, I don't know. I guess it's fine. Like I love answering questions and I love talking with people. I feel like, especially, well, it depends on like where on Reddit too, because I just imagine like people on Reddit would probably take it as like somebody that just wants to talk about themselves, which obviously wouldn't be my intention. But I mean, I would be down, but yeah, it's not something I had set up before. The way I would think about that is like, if for whatever reason there was interest, for sure, but I don't really view myself as that interesting. So I wouldn't do something quite as like about Eric. So yeah, if it's helpful, I obviously would be happy to, but it's not something that I've like really thought about. Okay. Paulo says, more generally, how do you assess the odds of a short squeeze? Okay, cool. Great question there. So when looking at something like a short squeeze, there are a few things that are primary drivers. Actually, that video that I sent you is that. Because, yeah, so the way that I look at it, short squeezes become more probable in a few scenarios. High, short interest, so like greater than 20%, I think. And then large days to cover. Those are the two main things I would look at personally. And then exactly to off Putin's point, there's definitely squeezes that are driven by things like gamma. That's super common. Well, not super common, but in a relative in the world of squeezes, that's a common cause for squeezes. So yeah, there's different origins of a squeeze. Short squeeze are very, very specific, as are things like gamma squeezes. But for a short squeeze, I would look at short interest greater than 20%, and then days to cover definitely greater than 4 days. At the very, very least, probably like 6+. That starts to become like really, really appropriate, I think. And again, it can still be tamped down really fast. It doesn't inherently happen. But I would say that those objectively would raise the conditions. Vladimir Off Putin says, I asked because so many have questions. Yeah, I think, and I agree with you. And I think that the problem is a lot of like new options traders I find when I interact with them, because I'll post on the options Reddit once in a while, but I noticed that a lot of new options traders are just options traders in general. I think that they don't even know how far off the mark that they are. That I notice I have a hard time connecting with the people on like the options Reddit, because so many of them are at like such a basic level, and a lot of them think they're so much further than they are, that like trying to talk to somebody, like for example, if I made a post, actually, I think I did make a post about this. Let me see. I'm just curious now, because I think I made a post about profit mechanisms at one point on the options Reddit. Oh, let me see. Yeah, here we go. Literally perfect. And this is exactly why I think Reddit is a tricky place to operate. Because you can see, like I made a post about creating, like focusing on profit mechanisms, and you can see like literally it got downvoted into oblivion. So I think the thing is with people on Reddit, they're at like such a different level when it comes to options. It's so elementary that I think the way that I do things is probably not even relatable to them. That's what I think. Because, and I still go on Reddit to interact because I do know that there are people on there that are trying to figure this stuff out. Like they're trying. And I know that a lot of people will go there and, you know, try to get some information. So I do try to post there once in a while, again, to just try to help new traders. But the stuff that's celebrated there is the stuff that I actually think it just sets traders up. Like there was a post not too long ago that I saw that somebody had like a straight winning week or whatever. And like the Reddit exploded about that. Like they really, really love that, which is cool. I think it's really cool to celebrate each other's victories. But to me, the fact that people find that cool is so troublesome. And I think that explaining that to somebody would come across as me like trying to tear down somebody else, you know, who's doing well, which is clearly not my fucking objective at all. But people are like really sensitive and they're very superficial, I find, on there. So I try to share like straight up information as best as I can. I'll share a little bit about like my path and my journey, because I do think that that's probably helpful for people to hear, because it is helpful to see somebody that's, again, like not supremely educated, kind of just a basic average dude that has been able to figure some of this out, right? So I know that there's some value there. But yeah, maybe we can set up like an AMA. I don't even know really how to do an AMA. I've never done one. So, but maybe we can set one up on like a live stream or something. I don't know if that's easier. Is it better to do them on like a written platform? I literally have never done it. But I would be down. I just don't know how to do it. Doing it on like a YouTube Live's easy, but I don't know if that's the right format for how people would want to do it. Yeah. Ricky says, I feel like all your live streams are basically AMAs. Yeah. And I try to be like really open to questions. So then I'm glad to hear that, because that's one of the big objectives. I think maybe structuring something that's, I don't know if it's better to be more meta or less meta, because on the live streams and stuff, we actually spend very little time talking about like governance, meaning how I even started doing all this stuff, how I did this while I was like on active duty in the Marine Corps with a full-time job, deploying, like all those kinds of things are just not really spent on, because I generally don't care that much to talk about myself. But that would be like more meta. And then there's like sub meta stuff that would be like very, very specific with respect to approach. And those I feel like would be easy, because those we do all the time, right? Like talking very specifically about approach. And that's mostly with a lot of the videos are as well. So I'll think about it. Like one of the ways we could do it, if it would be useful, is I could set up like a Google form and see if people prefer to like submit stuff that way, so that if people like to like write out something, because I also know on YouTube Live, you're limited by the number of characters. It's like super succinct. So we could do something like that, like a Google form. And then obviously we can have more questions or whatever during the live session. If people are interested, I'm down. Again, I haven't really thought about it because I don't find myself that interesting to that degree, but happy to if it'd be helpful. Cedric says, did you start with trading or investing? Investing, for sure. I started with buying a few shares of companies that I saw, and I did that for like a few months, and then I immediately started pivoting to options. So yeah. And then Ricky says, what practice were you in? Deloitte, auditor at KPMG for a minute, and it sucked. Sounds like, yeah, I was in consulting. So auditor sounds terrible. There's nothing to me that sounds even remotely interesting about auditing. Dave Swag says, although our bank accounts have different dollars, there is still something extremely relatable to you. Yeah, well, it's because I probably bet whatever your bank account was, I probably had it and probably worse. I don't know. Maybe yours is like really, really bad, but I mean, I've definitely have had $0 in mine before. So yeah, that is straight up. So yeah, let me think about that. I'll actually work on setting up like a Google form, and then we can set up like a AMA session. I probably would do it on a YouTube live stream because I honestly much prefer these, and I'd rather talk to you all. It's way better than like responding to fucking Reddit posts, I think. But I can collect like different questions and stuff there and see and kind of integrate them. So yeah, I'll take a look at that. All right, gang. Super fun. I hope this session was useful. I hope that those common mistakes make sense. I hope that you have a pretty clear roadmap on how I would go about doing things. And then, as I said, I entirely encourage you to pop in the Discord, go into the beginners section because there's one there built for you, and you can share what you're working on with each other. I obviously will do my best to jump in. For the Patreon folks, we have a specific room that I obviously will do my best to prioritize called the Learning Lab, so that if somebody has like a roadmap they built, I can give you feedback. But the goal is to share the things that I really think are transformative for me and hopefully can make a difference in somebody else's trading career and approach. Because what I can tell you unequivocally is trading is not easy to start, but once you build the skill set, it genuinely is tremendously simple. And it is one of the very few things you can do that there are no clients, there are no meetings, there are no customers, there are no partners, there are no bosses. It is truly one of the few things you can do in this world that is as solo of an endeavor as you can think of, and all of the positives that go with that. Because even if you start a business, you're still responsible to people. You still have to, pay roles. You still have to make sure that your customers are happy. That is really, really challenging for people. And trading is completely different. Trading doesn't have any of that. Trading is just you. So whatever you're able to do is dependent on you. Tons of autonomy, but there's also drawbacks to that. A lot of people struggle to handle that amount of autonomy, which again, that's one of the reasons why we have our community, the outlier community, is to help support one another in that and to add some structure. So that's the idea. That's why I think it's worth your while. And even if you trade and realize that trading's not for you, you will be better off as a human being by at least going through the process of attempting to trade, understanding risk better, understanding yourself better. It's a win. The main thing is just don't lose all your fucking money, and then it's a win. I'll see you guys on the GME live stream tomorrow at 5 p.m. Pacific time. And then, yeah, I'll get a Google form genned up, and then we can set up some sort of AMA, which hopefully will be a good time. I would definitely enjoy interacting and sharing anything that's useful, so that'll be fun. All right, gang, be an outlier. I'll see you all later.